Again, thank you everyone for being here with us today, July 7th at 7 p.m. So it's a lucky day and lucky hour for those who are superstitious.
سلام چطوری؟ خوبی؟ خوبی خسته
Can
نباشی
everybody please mute
مرسی
themselves?
عزیزم.
Appreciate that. Uh, okay, thank you. Okay. All right, we'll get back to it. So we have a great webinar for you talking about the multiplexes. This is Multiplex Mastery, unlocking Toronto's biggest real estate opportunity. Like I said, I'm accompanied by my good friend and a great realtor and developer, Sid Siddiqui. Sorry, I butchered your last name.
No worries, Ali. No problem.
Yeah, you want to say a quick hi to everyone?
This is Sid. I'm with LePage Terrequity, and I specialize in multiplex. So here, me and Ali, we both are going to talk about it in detail, and let's keep everyone interested.
Yeah, thank you. All right, so before we get into the meat and potato, we got to talk about disclaimers, obviously. So all the information that we provide here tonight is for educational purposes and general information purposes and does not constitute investment, financial, or professional advice or offering of securities. Participants are responsible for obtaining independent legal, accounting, financial advice from licensed professionals before making any investment decisions. So with that out of the way, let us introduce ourselves real quickly. For those who don't know me, my name is Ali Nazarian. I'm a professional engineer and a professional project management professional. I'm an engineer turned real estate developer, investor, and coach. I used to work in oil and gas industry across the world, in Asia, across Canada, North America, Middle East. And I have years of experience in engineering, project management, and risk management. So I took different roles. I've managed projects
यार
that
ये अली फिर भटक गए कॉन्डो से उस पे आ
okay.
गए उस दिन मुझे फातिमा ने कहा
Just gonna have to make sure everybody's muted. Okay, I think that's better. So yeah, I've managed large industrial projects, offshore projects, onshore projects that were hundreds of millions of dollars. So that's the experience that really helped me get into development and real estate development. It's been a really exciting journey. I started my own investing journey in 2016 and I started my development in 2017, which I'll show you. I started with a duplex in Alberta and basically business grew from there. And since 2023, I've been doing development consulting and coaching as well, helping people across the country build projects from a 2-unit garden suite all the way to 168 unit net zero energy, or actually net positive energy village that will be funded by some government agencies and whatnot. So I've dealt with different provinces, different type of developments, and different people that have been help. My passion is development. That was my dream growing up. I always wanted to be a developer, and you can say I'm living my dream. I love innovation. I love energy efficiency. My background, like I said, is in mechanical engineering. So that has really helped me with when it comes to the programs that we're using now, which we will talk about. And right now, I have projects across the country, Ontario, Alberta, and New Brunswick, focusing on missing middle, as we call it. So this is my company, EcoLux Developments. We are a development management and consulting firm, and we focus on purpose-built rental projects. We are very niche and narrow. We stay focused on that. We don't do condos, townhouses for sale, or anything like that. We are specialized in rental development, rental projects, multifamily development using CMHC programs. And so my passion is basically company's goal or vision is to help homeowners, investors, and developers achieve success in their projects. Again, just quickly on the services that we provide as part of EcoLux Developments. Like I said, development management, consulting. We do feasibility studies, financial modeling, market research, and energy efficiency solutions. So some of the recent projects. This is that very first project. It was a 2-unit house in 2017 in Alberta. Land severance, very large land assembly rezoning in Alberta. There's a 14-unit in London. There's a 10-unit in Welland that I'm about to start, and this is a 28 units development in St. John, New Brunswick that we are about to break ground in a few months. And these are all done through CMHC programs. So I'll pass it to Sid with that.
So hello, everyone. Can you hear me? Ali, you can hear me?
Yeah.
So thank you, Ali, for passing it to me. And you'll just have to help me with the slides when I have to move forward.
Yes.
So everyone, my name is Sid Siddiqui. I'm a real estate broker with LePage Terrequity. I work in downtown Toronto and GTA in general. I am mostly focused on missing middle housing. So that's my specialty. I can help people source these kind of properties, and that's what I do all day long. Before real estate, I was into medicine. So I tend to look at properties as if I'm diagnosing them. And I've helped multiple clients evaluate missing middle housing properties to Major Street and all these places, right? Currently, I'm building my own 4+1 development in Toronto. It's around the Junction area. And so whatever I'll be talking today, it's going to be more of experience-based so that you get the actual insight and so that we give you proper, so that you have, we don't waste your time. Other projects which I'm currently working on, Ali, if you change the slide, thank you. I'm currently working on a 147 unit brand in a property in Brantford. It's a 12-story project. The other property which I'm working on is on a major street, which is 6-story, 60 unit development. There was one more rendering which had to be there, which was my 4+1 development, but no problem. I'll be showing you in the next slides. So these are the projects I'm working on currently. So just to, yes, Ali, we can change it. Thank you. So just to give you a background, City of Toronto is pursuing gentle density throughout EHO as a key tool so that they can meet their housing action plan. They need to build certain number of houses. And basically, this is the requirement for the city. Otherwise, there would be issues and there'll be housing crisis. So city is working towards that. So in May 2023, multiplex bylaw amendments passed, allowing multiplexes to be built up to 4 units in the neighborhoods. Previously, in neighborhoods, you could only have a detached house. Later on, city changed the zoning, and that day, I would say, the highest and best use of a lot or of this entire neighborhood's designation changed. And many people are not even aware of these changes. Like they are sitting on, I think, gold mine, I would say. And 100%. In June 2025, council approved further permissions, like in certain municipalities, not in entire Toronto, I would say, but in 9 municipalities, you could build 6-unit multiplexes instead of 4 units. Everywhere you can build 4 unit as of right, no questions asked, right? But in 9 municipalities, you could build 6-unit multiplexes. So just imagine the upside, how much upside, like just from a single family home, you've moved to 6 families, like you're giving place for 6 families on the same lot. So just imagine the upside. Ali, we can move to the next one. So the neighborhoods which I was talking about, so you see the yellow part in this map, those were all neighborhoods and they only allowed for detached houses. Only few areas would allow for multiplexes here and there. But if you see now, this entire thing allows for 4plexes or 6plexes in other municipalities. Like people sometimes say, like, we don't find opportunities, like we're not able to find the right property. Just look at the map and see how big the opportunity is. You just have to look in a particular area and you can see different opportunities. So the 9 wards which allow for 6 plexes are these wards. So ward 4, 9, 10, 11, 12, 13, 14, 19. Other wards also have an option to allow 6 plexes, but they have not yet chosen to, but still you can make 4 plexes on any lot. And so you'll see we've put a star on the green one. You'll see Toronto and East York. They allow for 6 plexes. And then you'll see the star in the Scarborough North. They allow for 6 plexes. Rest all the other lots, you can make a 4-plex as of right. And yes, if your lot allows for it, you can build a garden suite or a laneway suite behind as well. So totaling of 5 units or 7 units. We can move forward.
This is a historic opportunity. Toronto has historically been very difficult to work with, and adding more units. They were very protective of this so-called neighborhood characteristic, and they were against basically adding density. But with the housing crisis and the demand and the work of many planners and activists, they eventually decided to allow this. So this is a really like a once in a lifetime opportunity, and I think we're all lucky to be living at this time in the history of Toronto to be able to take advantage of some of these. So some of the benefits for homeowners and investors, you might say, okay, what does this do for me? Why should I care? So here are the top 5 reasons why you should care about this. This is the opportunity for you to own a brand new rental building. For the longest time, owning a brand new rental building was not viable or feasible in Toronto. All you had were these like 1950s, 60s, 70s buildings. Usually they're like larger apartment buildings. They're not really attainable for everyday investors. You would need millions of uh, capital. You would have to have a lot of capital set aside for all the maintenance. Like imagine a 50, 60-year-old building, apartment building, the amount of maintenance costs is just astronomical. So this is a really unique and once in a lifetime opportunity to own a brand new building without basically all the limitations that used to exist. And it's a great vehicle for long-term wealth creation through appreciation and mortgage pay down. Hands down, owning apartment buildings is the best proven vehicle or tool for creating wealth. A lot of wealthy families, including some, not naming names, but presidents and people around the world have built their wealth through owning rental buildings. And there's a reason for that because they're predictable, they are always in demand, and it's an essential need. People need a place to live. And as your tenants are paying down your mortgage, you are recapturing that equity, and the market eventually basically appreciates as well. Another reason, again, kind of mentioned in the earlier point as well, it's a stable, predictable, long-term cash flow. And that's the key, predictability. Older apartment buildings, they're not predictable. You could be collecting good cash flow, but your roof starts leaking, even on a small building, that could be $40,000, $50,000 cost. Or your boiler goes, that's like $50,000, $60,000. It's not like a house that you can wrap it up with a few $1,000s. But a brand new multifamily, it basically is brand new, so it's not going to have an issue for a very long time. So you can really predict what your cash flow is going to look like. The other one is unlocking equity in mortgage-free properties. This, I think, is the single biggest opportunity right now in Toronto. For those who have owned their properties for a long time, maybe they bought it 20, 30 years ago, they've paid off their mortgage, they're now sitting on a really rundown old building that is just costing them a lot of money to maintain. Roof leaking, furnace breaking, they're drafty, air leakage, all that stuff. And they could be sitting on $1 million of equity, but they could actually be cash poor, but equity rich. This is a really unique opportunity to tap into that equity without requiring personal income or additional capital to basically own a 5 to 7 unit property, which actually generates cash flow and is brand new. And the other greatest thing also about this financing program through CMHC, which we will talk about, is there are no personal income criteria for financing through CMHC. We'll touch on that a little bit. So if someone is retired or just doesn't want to work, or new immigrants that are new in Canada, they've bought a property or they have some capital, but they don't have income and they can't qualify for mortgage, this is a huge opportunity where the equity you have or the capital you have could basically account for your net worth, and that can allow you to access the financing to do a project like this. And other things that makes this multiplex opportunity really unique and once in a lifetime, and makes it basically something that is working right now. And why should you do it right now? There are development charge exemptions. For those who are not familiar, development charges are something that the city charges the owner or the developer to allow for development of that property. Let's say you have 5 units. It's roughly about $50,000 per unit that you have to pay to the city to allow you to build that. And that's not your building permit cost. This is just to allow you to basically apply for your building permit. And it's really a money gouge, but we're not getting into the philosophy of that. But on these 5 to 7 unit multiplexes, you could be saving up to $350,000. A couple of years ago, you would have to pay this amount to be able to build these things. And that was one of the reasons people were not building them. Another one that's really huge right now, and that's 100% HST rebate. When you build, you pay HST. When you're done, you pay what's called a self-assessed HST. This could add up to $450,000 to $550,000. And this is what you're not paying today. I say potential because if you're doing conversion, this would not apply. So you're talking about brand new, demolish the old house, build new. Faster timelines, as Sid mentioned earlier, we used to have to jump through a bunch of hoops to get approved for even 3 units in some of these neighborhoods. Right now, you're allowed, it's as of right. So this is saving you $50,000 to $100,000 in carrying cost. It used to be that you buy the property, you keep paying for the mortgage or the expenses to carry it for a year or two until you get your zoning approved or changes that you want to ask for concessions from the city. And that could add up to $50,000 to $100,000. We have CMHC financing right now that would allow up to 95% loan to cost and 50-year amortization. So this is also huge. This has been a game changer in the past few years. I've done like 5 projects through CMHC, and it's a game changer, I can tell you. It's not the easiest thing to deal with. There's a lot of paperwork and a lot of nuisances to do it, but it really helps with better cash flow from your property. Right now, there are lower land and construction costs, so that allows for higher profit margins. We will touch on that in the future slides. And lower interest rates right now. The interest rates are lower, so that allows for better financing as well. These multiplexes will fall under commercial financing. So generally, you're getting better rates and better terms than residential financing. There is support from all levels of government. It has never existed in the history of Canada that all layers of government, federal, provincial, and municipal, are all aligned in increasing the housing supply. So there's less resistance and there's less risk in doing this. There's also an opportunity to condo split these multiplexes, which creates an additional exit option. Right now, the condo market is not great, so we're not going to spend too much time on that. But if anybody's interested, we can always talk offline about it. So there is a soft market fallacy right now going on in the market. Everybody's like, investors are sitting on the sideline saying, oh my God, the market is soft, the rents are softer. Yes, that's true. The rents are coming down. In Toronto, in late 2023, we peaked at about $3,000 average rent. And this is the data from Urbanation, which is one of the biggest research companies, which owns rentals.ca. We went through up and down a little bit. Right now, we're sitting at $2,500 on average rent. And you can see it's stabilizing and it's slightly going up. So it's likely that we're at the bottom of it, and it's gonna go up from here or just stay stabilized. Nobody knows the future, but it is true. But guess what? It's not for all unit types. So if you know what you're doing, you know you're putting the right product on the market, the rent is not down for everything. Yes, you can see for most cities in Canada and for most unit types, the rents are down. But look at this number. I mean, forget about Montreal. That's a different country almost. It's in Quebec. So there's demand in Montreal, different market, but we're talking about Toronto. 3-bedroom units in Toronto, they've actually gone up since last year, almost 1%, whereas 1-bedrooms have the biggest drop and followed by 2-bedrooms. And this is for purpose-built and condo rentals. So not all unit types are created the same and they're not affected the same. To add to more of that fallacy, yes, rents are going down, but guess what? The land cost is going down as well. This is the chart that Sid pulled. We worked together to pull this from the MLS data. This is the median sale price in Toronto for detached homes that are more than 50 years old over the past 10 years. You can see we had the peak in 2017, and then it dropped, and we go through cycles. And then there's seasonal cycles. You can see the up and downs, but it trended down and then it started going up. And then we peaked really crazy in 2022 because there was basically free money on the market and the interest rates were very low. So the prices peaked up. But since then, the rents have come down, but also the land cost has come down. So the reason we're showing you the detached 50 plus years homes in Toronto is because those are the candidates for being demolished and building multiplexes on them. So we're paying less for land, so that's basically helping, but also construction costs are coming down. You talk to anyone that's in the construction business, contractors are constantly undercutting each other and pricing down to win the job because there's not much activity on the market. So it really creates an opportunity to get in and own one of these properties at a lower cost. And another factor is also interest rates are down. So CMB is Canadian Mortgage Bond, which is the basis for these commercial financings that CMHC does. And you can see back in 2023, we were really high up. And then it's been, obviously it goes through cycles, but it's been trending down. There's a little bit of a spread, so don't just look at this as your interest rate. I think today you could safely expect about 4% interest rate if you're doing a multiplex in Toronto. So now let's talk about financing. How do we finance these multiplex developments? So MLI Select is the main go-to. I'm sure everybody has heard about that. If you haven't, this is basically a government-backed financing that allows amortizations up to 50 years. So it's 95% of loan to cost. So for new builds, for new construction, it's based on cost. If you earn certain points, it's a point system that is based on affordability, energy efficiency, and accessibility. And depending on how much point you get different basically flexibilities in the financing. The range you can expect that for the rate during construction is prime plus 0.5 to 2%. So in today, it would be about 5 to 7% during the construction. And then, like I said, about 4% for what we call the term loan when you get into your 50-year amortization term. The great thing that makes this very powerful, besides 50-year amortization and 95% leverage, is that the minimum debt service coverage ratio is 1.1. That's basically how much income the property is making versus how much debt it can take. So this is unique. Conventional financing before CMHC was out there, it was like 1.25, 1.3, meaning you could get a smaller loan as compared to CMHC. And there's a little bit of fee involved. There's broker fee and lender fees that adds up about the 1 to 2%. So what the flexibilities look like, if you're getting 50 points, which I'll show you what the point system looks like, you can get up to 40-year amortization, but you can still go to up to 95%. It doesn't mean you automatically get 95%, but it's up to 95%, depending if you can meet the debt coverage ratio. If you're getting the maximum point, what we call level 3, 100 points, you can go to 50-year amortization and up to 95%. Not every project will qualify for 95%. Our project in New Brunswick does qualify for 50 years and 95% financing. In Toronto, you can expect a little bit less. We will look at a case study a little bit later on. So the requirements, and this is the important part. What are the requirements? How can you qualify for this mortgage? So one of the requirements is net worth, personal net worth. You're required to have 25% of the loan amount as your net worth. If you're taking a $3 million loan, you need a quarter of that, or about $750,000 in net worth to qualify for the loan. You also need to personally guarantee the loan, which is normal. This is just like any other loan. There's social outcome requirements. As I mentioned, there's affordability, energy efficiency, and accessibility. Affordability, it means the percentage of units that are at 30% of median renter income or lower. And CMHC published this data. There's a table that we always check when we go into a market. In Toronto, the number is about $1,200. So it's pretty low, even for a bachelor unit. So most people don't use affordability in Toronto unless you're a social housing or a non-for-profit. Accessibility also has a lot of basically requirements, a lot of details. Pretty much you cannot qualify for this unless you have elevators for every floor. So the main thing that we focus on when it comes to Toronto is energy efficiency. And to qualify for energy efficiency to get the points, basically to get the 50 points, you need to be the energy efficiency of your building needs to be 60% better than the National Energy Code, Tier 1, or 70% of National Building Code. Don't worry about understanding these things. Obviously, we can help you, but energy advisors will do this modeling, and they'll tell you what you need to do to build this. We have a lot of experience in managing these and designing these buildings. But basically, your professionals will help you. What you need to understand is that there's a certain criteria to qualify. So you need to be able to navigate all these requirements and make sure you design your building from day one purposely for the rental and purposely for CMHC MLI Select to make sure you are basically maximizing the benefits of the program. So with that, let's look at a case study. Let's look at what this could actually look like. So we're going to look at a property located at 100 Dunkirk Road. This is in Danforth Village, East York. I'll show you the location quickly in the next slide. You can see the picture here. It's a pretty old building. It's 100+ years, single family, it's detached. The key point here is that it's a 25 feet by 134 feet. So this is perfect for a multiplex development. It's zoned RS. This was sold in February 2026 for $725,000. Sid, maybe help me out here. Would you ever imagine being able to buy a single family home in Toronto for this price even a year ago, even 2 years ago?
It was not possible. Like when we were buying properties for my project, I remember the market price, average price for these type of properties were more than $1 million. If someone was very lucky, he was looking somewhere around 950-ish. Just imagine the difference. Like it's at least $200K difference just in purchase price.
Yeah, thanks for that context. And so when we talk about, yes, that soft market fallacy, That's what we mean is the rents are lower, but also the cost is lower as well. So the math is mathing, as we call it. So this is an actual case. This is not a hypothetical that we could buy it for this price or we could do this or that. This was sold in February of this year for $725,000. And now let's look at basically what this looks like if you were to do a development on that. So this is, we're assuming we're doing a fourplex with a garden suite. So a fourplex, it basically means it's a 3-story building with a basement. So one unit per floor. So you have one unit in the basement, one on the main floor, one second floor, one on the third floor. And then you have a garden suite at the back. So this creates basically 5 units. So we're looking at about 1,100 square feet. These are basically assumptions. 1,100 square feet, 3-bedroom units in the main building. And the garden suite is a 2-story, 600 square feet per floor. So that's 1,200 square feet, which is a nice, basically a small house. This could easily be a 3-bedroom, 2-bath. And for rents, we could expect the basement to rent for about $2,800. The main floors in this area would be around $3,100 for the 3-bedroom. And these are conservative. Depending on the design, depending on how nice you can make it, you could expect you can get even more rents. We have seen 3-bedroom units, more like 1,200 square feet, renting for $3,700, $3,750 in Toronto. And the garden suite, we're assuming $3,500. And the cap rate in this area is 4.25. For those who are not familiar, when it comes to commercial financing, like 5 units and above, the value is based on the income of the building, the net income, the net operating income, divided by the cap rate. And cap rate, that's basically what the appraisers will determine based on the expectations of the returns. So it's important to mention that some people might have question on it. So when we look at the location, what makes these properties, and Sid will talk about how to pick the right property, but we always want to make sure we're in an area that is walkable, has good transit, and it's good for bikers. So this one has a 92 walker score. It's a walker's paradise. And this is directly from Walker Score website. Lots of transit, lots of bike routes. So it makes it a great location for a project like this because we're not putting parkings, right? So for those who might have that question, you might be able to get one spot, but in most of these, there's no parking requirement. I should actually add that to the list of all the opportunities and benefits of multiplexes in Toronto right now, but there's no parking requirement. So that's what makes these possible. So basically, your tenants are relying on public transit. You're aiming for that kind of demographic. So now let's look at the numbers. And I'm sure everybody's thinking like, okay, this all sounds great, but what does these numbers look like? So we wanted to show you real numbers, what this actually could look like. So in this scenario for this project, 752,000, that's basically the 725 closing purchase price plus some closing cost and land transfer tax. There's about soft costs of about $110,000. That's all your architects, engineers, fees you have to pay, building permit costs, and all that, all those expenses. Hard costs are about 1.87, so call it 1.9. This is based on the square footage. Obviously, this can change depending on the design. We usually try to go with a simple design that is efficient to build to lower the construction cost. And then there's financing costs as well involved. You have to pay interest during the construction. There's lender fees, broker fees. So all in all, this is costing a total about 2.9 million, a little more than that, 2,950,000 almost. Yes, I know this sounds scary. Oh my God, $3 million cost. How are we going to make that work? But let's look at the valuation. So this building will generate about just over $181,000 of rental income, including vacancy. And then there are some expenses, about $37,000 in expenses, your property tax, insurance, property management, snow removal, lawn care if you have any lawn, and if some occasional small maintenance items you have to do. Again, keep in mind this is a brand new buildings, so for the first year or two, you're under warranty, and then a lot of your equipment are all under warranty. So there should not be much of an expense. So that basically translates into a net operating income of $144,000. So if you divide $144,000 by 4.25%, which is the cap rate for the area, you will get a value of almost 3.4 million. So there's about a $450,000 lift here, or you can call it profit. But let's look at what the financing looks like for this. So based on the CMHC financing, going with 50 points, just energy efficiency, this would qualify for 89% loan to cost. And then with including the CMHC premium, your total mortgage would be almost 2.8 million. So the equity that you need to put into this, it's only $324,000. It's mind-blowing to be able to own 5 units with that much equity. And you're getting around a 4% interest rate and 40-year amortization, which makes all of these possible. And by the way, if you have questions, put them in the chat. I should have mentioned in the beginning. Put your questions in the chat, and at the end, we'll get into the Q&A. So basically, your equity at completion, when you're done with this project, you now have almost $600,000 equity. And that's how you build wealth. This is real wealth built. You're basically creating forced appreciation, and you're creating that additional equity in your property. This could be a property that you had, I don't know, like you were mortgage free. If it's worth $725,000, you're basically now getting all of that difference out as basically a payout from your mortgage. You're without having to pay out of pocket for some crazy amount of mortgage payment every month. But now let's look at what this looks like when you hold it for 10 years or 5 years. This is where the magic happens. So in year 1, you have your income, you have your expenses, you have your net operating income of about $153,000. You're paying $140,000 in mortgage payments. So in the first year, you have about $13,000 of cash flow. That's just over $1,000 a month, which translates to 4%. COC is cash on cash. So this is basically the amount of cash you're putting in your pocket, because if you remember from the previous slide, you have about $324,000 of equity in there. So if you calculate, this is about 4% return. This, when you're comparing, if you want to think about it, is this a good investment or not? The cash on cash, because that's the money you're getting in your pocket every month. This is not even calculating your mortgage pay down or appreciation of your property. This is what you need to compare with a GIC. So if you're getting 3% from your GIC, but you get 4% here, I would take this any day. Again, I'm not giving financial advice, but for me, this is a great deal. But obviously, if you hold it a little bit longer, you're paying down your mortgage, the rents will most likely start going up in the next 5 years. So in year 5, you're now looking at about just over $25,000 of cash flow. And now you're looking at almost 8% cash on cash return. And by year 10, you're looking at almost $43,000 of cash flow. Just think about that. And what that can mean for you, for your life, for your family, and for your financial freedom. That's almost a 13.2% return on the equity that you have in the deal. So if you want to know like actual dollar values, I'm not going to go into the math, but basically the property value is projected to be about 3.9 million in year 5 and about 4.3 million. So by year 5, you have about 1.2 million, almost 1.26 in equity, and 1.86 by year 10 million dollars. So this can really, one of these buildings can transform financial future of a family, just owning one of these. And if you project this little bit longer, number will look even better. But for those who like to look at numbers and percentages, we're looking at a total profit of almost over $1 million over the 5 years and just over $2 million in 10 years. And that translates to annualized return on investment of almost 53% in the first 5 years. And you're reaching about 60%. I see a question is, what's the assumption for the increase in the value? It's basically assuming that's mentioned here is 2% rent growth and 2% expense growth. And if anything, in the next 10 years, and this is assuming the cap rate does not change. For those who are familiar, I can explain this offline, but we're basically assuming that the rent just only goes up 2% average over the first. I know you might ask, like, by this year to last year for 3 bedrooms has only gone up 1%, but this is an average of 5 years or 10 years. And expense growth, that's basically just in line with inflation. So 2% rent growth and expense growth is a standard assumption in creating projections for the returns. So this is where the magic happens. This is where wealth is created. And this is why very wealthy people always own multifamily in their portfolio. They could be putting money in stocks, in Bitcoin, in gold, and diversifying, of course. We're not saying anyone should just put all their money into this. But as far as I know, all wealthy people own some scale of multifamily, which is basically these rental buildings. So with that, I'll pass it to Sid to now talk about how do we find these properties? How do we qualify? How do I even know if I own a property? How do I know if this would qualify for doing a multiplex? So, Sid, help us understand, help our audience here understand how do we determine and what should we look for? I know you have a lot of experience. You've held a lot of clients that we have worked together, help them find the right property and build the right property. So yeah, please take it away.
Yes. Thank you, Ali, for the wonderful presentation. And now we'll continue with what I call as an interesting side of this entire thing, right? So now we've understood the numbers, everything we've seen in the neighborhoods, you can build these properties, but there are like thousands of lots. How do you find out which lot works and which lot doesn't work? Because you cannot go and make offer to any random property. It's just not going to work out, right? So it has to be very specific and you need to follow certain criterias and you have to filter them out, and then you are left with only few properties. So how do you filter them out, right? Before I get into that, I want to show you one biggest red flag I've seen, which is not there in this presentation. I just realized, so I'll just talk about that. Nowadays, many of these neighborhoods, like you must have seen, many people don't like these developments coming in their neighborhoods. So they put restrictions on the title. So you'll find properties with restrictive covenants, and they are registered on title which say you cannot build anything other than a single family home on this lot for next 35 years. Now imagine you buy a lot, something like that, and you miss these title searches and all these things, or you forget to inform your lawyer, and now you're sitting with a detached house which cannot be converted into a multiplex, right? So these things, like this is one of the things which I've seen people make mistake with. Now we'll talk about the filter criterias which I commonly use. Very first thing is the zoning. Now you'll say, we've just said in the neighborhoods, all the zonings, they allow for fourplexes. Then why are we checking for zoning? Because every zone allows for fourplex in the neighborhoods, but all the zones have some zones have different constraints, some are easier to deal with. And we'll talk about it later in the next slide. Then there's issues with lot sizes. You cannot buy any lot. It has to be of particular size if you're planning to build a fourplex and a garden suite, or sixplex or a garden suite, right? There are height restrictions. Even if the zoning allows, there are height restrictions. You cannot go to 3 stories in some of the zones, right? Then how do you find out how to like put a garden suite or a laneway? What is the location of the fire hydrant? What about the trees? What's the situation with the utilities? Is the property close to railway, creeks, power lines, etc.? And we'll slowly get into these details so that we do not make a mistake when we are actually looking for these properties, because this can be someone's entire income for maybe they must have got for 10 years and now they're putting into one deal. So it has to be done perfectly. Ali, can we please change the slide? Thank you. So talking about the zoning, in the neighborhoods, usually you'll find R zoning. So residential multiplex, residential common, residential detached, or semi-detached. But then there are commercial zones as well. Ideal zone would be a commercial zone, but the problem with that is the land cost is very high in those zones. So we usually avoid those zones. Residential multiplex, that's an ideal place to be at, very less constraints with it. Then R zone, RD, RS, I usually club them together. Ali, can we move to the next one? So usually I club R, RD, and RS together, and let's talk about these 3 together because they usually have same issues, and then RM we'll talk separately. So if you find a lot which is in an R, RD, or RS, you can only build a 2-story property. You can change this by reducing your setback. If let's say you want to make a 3-story property rather than a 2-story property, your main wall height from the front and from the back has to go 1.4 meters inside. So your 3rd floor becomes smaller. Now just imagine you have underwritten a deal where all your properties need to be 3-bed, 2-bath to get you to the valuation. And imagine your 3rd floor becoming smaller and you didn't know about this, right? And so this is one of the significance of understanding the zoning and what you need to look for. And based on that, you have to do those calculations. Ali, can we move to the next? And then that was just about the height. Now talking about the lot size. So to put the perspective, the standard in Toronto was you can have a building depth of 17 meters. You build a detached house, you build multiplexes, you do anything, you can have a building depth of 17 meters. But then city realized if people are building multiplexes, they need more depth. So city changed these rules, but then they put certain criterias as to, let's say, okay, you want bigger building depth. You want to go more than 17 meters to, let's say, 19 meters. Your lot needs to meet certain criterias. In the next slide, I'll talk about those criterias. So city divided those into 2 types. So first is you either have a narrow lot or you have wide lots. Narrow lots mean any lot which has a width of less than 10 meters. Wide lots are lots which have width of more than 10 meters. So let's say if your lot is less than 10 meters, that is roughly 32 feet wide, you need to have a lot depth of at least 118 feet. Otherwise, you cannot increase your building depth from 17 meters to 19 meters. And trust me, those 2 meters, when you work with your architect, every meter, every feet matters, because to put a good layout, like how Ali was saying, you need good layouts. You need to put 3-bed units on the market. If you put something like a 1-bed or a 2-bed unit, it's going to compete with a condo. And we are not building condos. We're building a product which people really want to live in, right? And if you talk about the more than 10 meter wide lots, then you need to have at least 130 feet depth of the lot. Then only you can go 19 meters. Otherwise, your main building has to be 17 meters. But that's not the case in RM zone. All this situation was about R, RD, RS. Now you talk about RM zone. In RM zone, there is no restriction about the building depth. You can go till the backyard setback. I have seen people using this gap in the multiplex zoning bylaw and going at least like 100 feet deep properties. Otherwise, you're like stuck at 19 meters, which is roughly at 62 feet. Even if you go into minor variance, you're roughly around 70 to 72 feet. Ali, can we move to the next? So that's the beauty of RM zone. And I really love RM zone because of that. And plus in the RM zone, you can have third floor as well. Like third floor can also be full size. It does not need a setback on the third floor. So all the units, all the floors can be, if you're making 3 beds, they'll all be like 3 bed, 2 baths, right? So now and these were the things we were looking for in the main building. Now let's put our focus at the back of the property where we would be building a laneway suite or the garden suite. First of all, what's a laneway and what's a garden suite? If there's a lane behind the property, like behind your garage, and you're building a house there, then it will be called a laneway suite. If there's no lane behind the property, then whatever you build, whatever accessory structure you build would be called a garden suite. But in these two as well, let's say your lot has a laneway behind, I would pay a little more for that property. And I'll tell you the reason why. For a laneway property, if you're building a laneway suite, you can go from lot line to lot line on the sides and you can build the property. But yeah, there's one consideration you have to keep in mind, that you cannot have side-facing windows. And if you comply with this, you can build a full-size laneway, lot line to lot line, which gives you a very efficient layout. But whereas in the garden suite, you would have to keep 0.6 to 1 meter setbacks on both sides, so the property gets smaller. So if you're trying to put a 3-bed, it can get really sometimes tough. And we'll move to the next slide. And then I'm coming back to the main building and the garden suite. Here, many people make mistakes. So when you're calculating a lot size, let's say you found a lot, it's some 120 feet, but how do you decide if it fits your main building and it also fits your garden suite or the laneway suite? So one of the criteria you have to understand, if you're building a garden suite, which is just 1 story, then you can have a setback of 4 meters between the garden suite and the main building. But let's say if you're building a 2-story property, then you need to have like 2-story garden suite, then you need to have 7.5 meter setback between the main building and the garden suite. Other thing I always see investors making mistake is about the front yard setback. So let me tell you one thing. If the zoning says the front yard setback has to be, let's say, 10 feet, but do you think the city would actually allow you to keep 10 feet setback? It really depends. The answer is no. Let's say your 2 neighbors have a 30 feet setback. City will not allow you to have a 10 feet setback, even if the zoning allows for it. You need to have a 30 feet setback so that you comply with the neighborhood. So you have to calculate those things in mind, like 30 feet, then main building, then 7.5 meters, and then the garden suite. So that's how you calculate the lot size. Ali, we can move to the next one. And another thing, when I'm at the property, I would be always looking at is the position of the fire hydrant. So usually what the city wants is if there's fire, let's say in the garden suite, they want to see if the fire truck can, be there and it's accessible for the firefighters. So wherever the fire truck can park closest to the house, the hydrant has to be within 45 meters. And from where the fire truck parks to the garden suite, that length also has to be 45 meters. But we can increase these lengths to approximately 90 meters, depending on, then you would have to put better insulation, sprinklers, etc., and that adds more cost. And then we'll move to the next slide. This is big. Like, I have seen many projects getting red signals just because of a protected tree. They are the biggest project killers. And how do you find out if the lot you're taking into consideration does have a protected tree or no? So if let's say there's a tree in the backyard and it has a width, let's say a diameter of 30 centimeters or more at the base height. So from the base, you have to go 1.4 meters up, and that's where you take the diameter. If it's more than 30 centimeters, it's a protected tree. You cannot touch it. And it's very tough at the city. Like, the fines are also very expensive. So you have to really consider where the tree is positioned. Would it come between your main building? Would it come between your garden suite? It's comparatively easier if it comes in between the main building. It's easier to remove it. But for garden suites, you cannot remove a protected tree. That's very tough. And we'll move to the next one. This other thing, this affects the schedule of your project. So just remember, we are converting a single family home to a fourplex. Now imagine the energy consumption upgrades needed, right? So the power consumption requirement increases usually, but you can get it. Normally these houses have 100 amps, you must be knowing. But for multiplexes to have these efficiencies, you need to put at least 200 amps plus gas. But then nowadays we see in the MLI Select, the projects do not qualify with 200 amp plus gas. So you need to go with 400 amps with gas. But then getting 400 amps from Toronto Hydro is like a 6-month process and roughly costs something around $20,000. 600 amps I've never seen anyone do this till now. This would be the best, like it is the most energy efficient thing, all electric multiplex. But the problem is it's very expensive and very time consuming. I think there's a wait for like 2 years to just get the 600 amp transformer. So those are the problems. So that is why whenever you're dealing with a project, the goal is to directly talk to Toronto Hydro on day one and understand their timelines. And definitely you have to get architect and your energy modeling team involved as well. And then we'll move ahead. Many people miss these things: proximity to railways, creeks, power lines. So the railway, if you talk about railway, it doesn't really matter until you go into minor variances, right? If you're going into minor variance, city might want you to register an easement on the property. And then whichever bank you have your loan with, they might have issues because they then have to go into the second place from the first place because you're registering an easement. And that's a mess after that, right? And it adds all cost and time, and it affects the deal. And definitely, if you have creeks around and power lines around the property, specifically about the power lines, many people have stigma related to it. So it affects the value of the property, and the tenants as well sometimes don't like staying close to the power lines. So it affects the deal in that sense. And then we move forward, Ali. So I'll give it back to Ali here.
Okay, thank you, Sid. That was great. A lot of great information there, and definitely working with the right people and right basically realtors that know how to find the right property for these kind of developments is very important. I think there's a problem with my video. You able to see me?
No, I
My video
cannot
is
see.
not working, eh?
It's not working. No problem.
Yeah, I don't know why is it not coming back on. Anyways, I'll just continue. So yeah, no, thanks for sharing all that information. But some of you might be asking, hey, like, how does this work? Like, where do we even start? So this is basically my EcoLux Developments development roadmap. Applies to multifamily and multiplexes. I'll go quickly on this because it's I sometimes do a 3-day course on this. But basically, it starts with identification and acquisition. This is where Sid was just talking about identifying a suitable site, negotiating the terms of the purchase. Um, the terms are very important, just like any property that you're buying. Making sure you have the right clauses in your agreements. If there's anything that, especially when it comes to like environmental things, making sure you have right documentation and right checks in place to make sure, you're holding the seller liable if they're not hiding anything, making sure that they're disclosing what they need to disclose to you. So yeah, identifying and acquiring the property is the first step. And then we need to think about ideation and concept, like analyzing the market needs, identifying the concepts for development. This is what we talked about, looking at, general sense right now is that 3 bedrooms work better, but you could be in a certain niche market area that maybe a 2 bedroom or 1 bedroom. Maybe the site has some constraints that you have to basically go to a smaller building. So just making sure that you have the right idea and the right concept. And this comes together with the financial feasibility and what we call underwriting. This is to determine the potential revenue and expenses, like the numbers that I showed you. This is what we do day in, day out. We do it for our consulting clients or for the clients that we're doing the development for, and also for our own projects, obviously, is probably the most critical item. This is how we can decide if this is the right project to do or not. Like those pro forma numbers that I showed you, that's how we decide. If those numbers come back at, I don't know, 8% annualized return, obviously, overall, or a negative cash flow, obviously it's not the right project. You're not in the right location, or you're overpaying for your land. So it all goes hand in hand. And then we get into the design and permitting. We make sure that it's the right design as a rental. It's very different. You can't go to someone that has been building single-family homes or custom homes for 20 years and ask them to design and build a rental for you. Building rentals is fundamentally different. We look at different things, different factors that are important to make sure you maximize your rent, and also durability of the material, the layouts. There are things that are important for tenants that are not important for homeowners, but there are also things that are important for homeowners that tenants wouldn't care about. So these are very important, and this basically we learned this by experience. And then it's looking at financing and capital, how much equity you need, how much financing you can get. We are able, because of our experience and expertise, we are able to do most of this in-house to determine from very beginning, like even looking back at like where we're thinking about putting an offer, or if you're owning a property and thinking about what we can do with our property, we can run the numbers and pretty much with good accuracy determine what kind of financing we will be getting. Obviously, we can consult with our financing partners that we work with, the broker partners that we work with, to verify everything when needed. And the next step, after the design is done and permitting, financing is all lined up, is time for procurement and construction. We're basically selecting subcontractors, basically hiring them, engaging all the subcontractors to do the work. And if you need help, we can also help with the marketing and lease up. But the general process in a multifamily development is that after you're doing your construction and basically completing your build, now it's the time to do marketing and lease up. On a smaller 5 unit, the marketing may not be as critical. Obviously, this process applies to larger projects as well, but that's something that we can help as well. But a lot of people just want to do it themselves. But one question that we get a lot is, what is the difference between a builder and a developer? It's like, can I just hire a builder to build this multiplex for me? The difference between a developer and a builder is the developer is responsible for the entire project, from the idea, from the concept, from financing, from marketing, to making sure that you're putting the right product in the right location for the right, basically target tenant profile. Whereas a builder is only responsible for the physical construction. You'll have to tell them what to build. There are builders that are now basically claiming that they can handle all of those things. They will do the design, they'll do the financing and whatnot. But that's something obviously to be careful with. A developer looks at the bigger picture, look at the financing pro forma. Every decision a developer makes comes back to that pro forma, the returns and numbers. If you're doing something that helps improve the pro forma and make the project more profitable, it's good to do. If it's not, then it's not good to do. A builder will probably not be able to answer that question for you. So basically, this is a role of a development manager. If you're a homeowner and you decide to do it on your own, you're basically taking the role of a development manager. And just to basically build on the previous one, site acquisition, the development manager is involved in that, making sure you're getting the right site, running the numbers, financial feasibility, due diligence, all that, making sure there's no environmental issue, there are no constraints, the legal reviews, like things that Sid mentioned. You're planning the project, the timelines, who does what, when. These are all important. The coordination. There's financial management, tracking invoices, making sure everything is paid. Basically doing your financing draws. So construction financing comes in draws. As you make progress, it comes in draws. There's a lot of documents that needs to be put together to be presented to lender to get your money as you finish the work. So that financial management and tracking expenses, HST, claiming your HST as you're building, these are all important factors that are part of financial management. Then there's the design and engineering. Not all designs are built the same. I can show you the same square footage of a multiplex unit. One gets $300-400 more rent, one gets less rent. And that's all comes down to the design. And that's where the expertise comes in, and knowing the market and knowing what tenants like. And of course, in the engineering as well, the energy efficiency, there's probably like 100 different ways you can achieve the same energy efficiency level, but which one works better? There is cost consideration, but there's also like comfort, the admin load that it's going to have. If you have too much technology in a rental building, this becomes a property management nightmare because people don't know how to use it. Believe it or not, we went to one of our apartment buildings and we were talking to the tenant. They had no idea that the split unit that's in their unit can do heating. And they've been paying crazy amounts for electric heating. And when we told them that you can change the mode of this to heating, they were surprised. So we can't just assume that everybody knows how to use technology. So those are important things to consider. Or you will be getting calls from your tenants every day, how to set things up. So important factors. And then this is the very critical part is managing the construction, all the trades, all the different subcontractors that are on site. So someone has to manage all of that. And then there's marketing, sales and leasing that needs to be done. And then there's legal and regulatory compliance as well. You got to make sure throughout this process, you're doing all your legal work and keeping track of everything that needs to be tracked. So basically, this is my analogy for the developer or the development manager is that you're the conductor of the orchestra. If you're the owner of the property and you're doing the development yourself, you're the conductor of the orchestra, and all your sub-trades, consultants, engineers, financing people, they're all the musicians sitting there. They're the best at what they do. But until you tell them what to do and when to do it and how to do it, they would not be able to basically build you what you have envisioned for. So with that in mind, I'm just going to quickly mention basically the development management services that we offer. Obviously, Sid is a great realtor. He's very, very familiar as a developer and a realtor. He's able to help you find the right property. I'll let him talk about that. But for myself, we have an end-to-end delivery service, development management services, or we can do targeted support for any project for those who want to be more hands-on. So from feasibility and due diligence to project planning and approvals, construction management, financing, and capital strategy. It is actually very important. Like, how do we strategize to the financing to make sure you are putting the minimum amount of down payment that you have to do and you're maximizing your return. So that's one of those things. Risk and governance, making sure that you're basically following the right steps to make sure everything is under control. And asset stabilization, basically lease up strategy, marketing, tenant placement. Obviously, in Ontario, tenant placement is a critical step that we don't want to miss. So those are things. Sid, did you want to quickly talk about how you can help people?
Yes, for sure. So what I would be doing is, since I am developing my own site as well, so I have this understanding. So like how I explained you how I'm analyzing these properties, not everyone can understand these things, right? Not all of the realtors understand this. This is a very specific, specialized thing which has to align with the developer as well, and which we understand. So I can help in sourcing these properties and making offers, and after that we can hand it over with Ali as
Yeah,
well.
so we can, yeah, exactly. And we have done this for multiple people. I would get involved as well at the same time. Like, obviously, Sid has the knowledge to identify the right properties, but we work together to make sure this is basically the right property, make sure that this could be a profitable development for you. So we're almost at the end. So what the process looks like. Basically, there are five main steps in this process. It's basically engaging in alignment. We will set up a call. We'll look at if you own a property that you want to develop. We will look at it. We see if it qualifies. We talk about like the scope and making sure everything is aligned. What's the best structure? If you're looking to purchase, we'll sit together with Sid, look at basically what you're looking for and making sure there's alignment. And basically, once we're engaged and we've found the property, or you already have a property, like I mentioned, we will assess and strategize. Again, everything that we talked about here, we'll do it. We'll do all the due diligence, zoning review, market analysis, CMHC pre-screening to see if you qualify, and we'll do that draft pro forma analysis as well. Then we get into planning and approval. We basically get quotes from sub-consultants. Obviously, we have our architects that we work with, but if you want to look at more options, we can do that. Getting the permits, building a schedule, making financing application can help with all of that. And then we move into build and deliver. We do the construction management, we can do the budget, quality control, and we can also draw management. So draw management, again, that's like dealing with lenders, quantity surveyors, to make sure you get your money at the right time and you maximize the amount of money that you get for every draw. And then the final step is basically the lease up support, making sure that everything is set up properly. And even if you need the help with basically tenant selection or coming up with a system, because we obviously own and operate rental buildings in Ontario and other provinces. So there's an existing system that we can help you use our system, or we are happy to hand it over. And some people just have experience doing lease up and rental management, so they can do it themselves. And then if there's ongoing support, we can always do that. So with that, thank you very much for being here. I guess you can't see me, and excited I am to wrap this up. We're almost in time. You can take your phone out and take picture of the QR code. We will also put our contact in the chat. You will also receive an email with the recording and our contacts after this, most likely tomorrow morning. But we're always happy to chat, even if you just want to explore and see what this looks like. And if it's the right fit, we're always happy to chat about that. So this is Sid's QR code. The previous one was mine. This one is Sid's. So feel free to scan that. And we can open it up to questions. It's too bad that my camera is not working. But if you guys want to, you can raise your virtual arm. There's a reactions button, or you can put your questions in the chat. So Ashish is asking, what is a typical timeline from acquisition till occupancy? I would say once you've acquired the property, if you're going as of right, meaning we're not going for any minor variances and we're just working within the limitations or the characteristics of the site. And Sid, feel free to jump into this as well. I would say probably about 6 months to get all your approvals and CMHC financing, 6 to 9 months. And then you're probably looking at about 12 to 15 months for construction. So I would say overall, probably 18 to 24 months. If you're doing any minor variances, you would have to add probably 6 to 9 months. What is your take on this, Sid? Oh, I guess you can stay on
I
mute
think,
so we don't have to.
Ali, you're absolutely right. What I usually consider is approximately 2 years. That's the standard I always consider.
Yeah. Yeah, I think more or less about 2 years from acquisition to occupancy. And that's another actually great point is right now the market, as we saw in the stats, is stabilizing. The rents are stabilizing. So even if you start now, again, the costs are lower, you're locking in the lower cost, but in 2 years when you're done and you're putting this in the market, even in a year and a half, it is likely that the rents are going to go up. Nobody has a crystal ball, but given the chart and how it's basically trending, it's stabilized, so it's likely that it will go up. So great question there. The other question here is like, where can we find zoning details? The relaxation for multiplexes is for GTA specifically. What about Hamilton, Kitchener-Barrie, etc.? Every municipality have their own rules. This is specifically about Toronto. This exemption of development charges and this relaxation of the rules are specific. Zoning details are available online, but also if you have a property that you're looking at, feel free to send us the address. We're happy to look it up for you. Either myself or Sid can do that. Other question, what government grants are available and how to stack them to reduce build cost significantly? So we had on a slide earlier about that. No problem, Ashish. I can probably quickly go back to that slide. So basically the HST rebates are the biggest one right now. So imagine like, actually while we're at it, the cost we're looking at here, basically call it 3 million. If we didn't have these incentives, you would have to add, where is that slide? There. You would have basically 350,000. Well, this one probably 250,000 for 5 units in development charges. And your as complete value of 3.4 million, you're paying 13%. So 3.4 million, I'm just going to do the math at 13%. That's 442,000 plus 250,000. So your cost would be almost $700,000 more. Plus, if you have carrying costs, you would have to add that as well. So this is basically how we're stacking those incentives. If you go to every municipality might have different incentives. Like in New Brunswick, we're getting incentives for missing middle. We're getting incentives for energy efficiency. If anybody, like we didn't talk about the investing in our projects, but that's something that we can talk offline if anybody is looking for passive investing in projects, that especially the New Brunswick one. But there's more incentives there. But in Toronto, the main incentives is the DC exemption, and the HST rebate is federal. So the federal portion is federal, and then Ontario has also matched that with the provincial HST. Yeah, no problem. So I'm just going to go back to the end with the so.
We've covered a lot, Ali, I think.
Yeah, we covered a lot of ground today. We know this was a lot of information and might be overwhelming. So feel free to reach out to us. Again, this is my contacts. and this is Sid. So we're here to help. Again, together we can pretty much handle any questions that you have, and we're always happy to chat. Again, if you own a property or you're looking at a property to purchase to make an investment, feel free to reach out to us, and we're happy to have a chat and see what we can help with. Any last minute questions? We have about 3 minutes. I want to be respectful of everybody's time, but happy to answer any other questions. Okay. If there are no other questions, I guess we're perfectly on time. So thank you everyone for being here, and we really appreciate you taking the time, and enjoy the rest of your evening. Have a good
Thank you.
night.
Thank you, everyone.